The financial world may be entering a phase that investors have not witnessed in decades. Over the last several weeks, markets that many analysts dismissed as outdated, slow-moving, or irrelevant have suddenly exploded back into the spotlight. Precious metals are surging. Energy markets are tightening again. Commodity indexes are climbing. And beneath the surface, some of the largest institutional investors in the world appear to be quietly repositioning before the public fully understands what is happening. Tonight, we are breaking down the deeper story behind this accelerating move in silver, gold, mining stocks, oil, and hard assets, and more importantly, why a growing number of macro analysts believe this could be the early stage of a much larger global capital rotation. Because this is no longer just about one metal moving higher. This is about inflation pressure returning at the same time governments continue injecting liquidity into the financial system, while confidence in traditional paper assets begins to weaken. And if history is any guide, moments like this have the potential to reshape entire decades of investment performance. Welcome back. This is your complete breakdown of the new commodity cycle that may already be underway. The move that grabbed everyone's attention this week came from silver. In a matter of days, silver prices accelerated sharply, producing the kind of volatility traders usually associate with crisis periods or major market transitions. What made the rally especially important was not simply the size of the move, but the speed and structure behind it. Professional traders often watch for moments when an asset spends months moving sideways before suddenly breaking above key resistance zones. These breakouts can signal that large buyers, often institutional funds, are stepping into the market aggressively. That is exactly what many analysts believe may now be happening in silver. For months, the market had been trapped inside a tightening consolidation range. Momentum slowed, retail excitement faded, financial media attention disappeared. But behind the scenes, physical demand remained unusually strong in several global regions. Then came the breakout. Volume increased. Momentum accelerated. Mining shares followed higher. And suddenly, silver was once again dominating financial headlines. But according to macro strategists, the real significance of this move is not technical. It is monetary, because silver's rally may be reflecting something far larger happening underneath the global economy. For more than a decade, financial markets rewarded one category above all others: paper assets. Technology stocks soared. Bond markets expanded. Debt levels exploded higher. Financial engineering became the centerpiece of modern investing. Meanwhile, tangible assets, commodities, industrial metals, agriculture, energy, and precious metals spent years underperforming. But now, some institutional researchers believe that imbalance may have reached an extreme. One of the most closely watched macro concepts on Wall Street compares real assets against financial assets. In simple terms, it measures how expensive paper wealth has become relative to physical resources and tangible goods. Historically, these cycles move in waves. There are periods when investors chase financial assets aggressively while ignoring commodities. Then eventually, inflation, supply shortages, or currency weakness trigger a reversal. And according to several recent institutional reports, current valuations may now resemble the kind of conditions that historically appeared before major commodity booms. That is why analysts are increasingly discussing comparisons to previous inflationary eras, especially the 1970s. Not because history repeats perfectly, but because certain monetary conditions appear surprisingly similar. To understand why commodities may be gaining strength again, investors first need to understand what happened to global liquidity over the past several years. Since the pandemic era, governments and central banks injected extraordinary amounts of money into the global system. Stimulus programs expanded. Debt issuance surged. Central bank balance sheets ballooned. Deficit spending accelerated worldwide. Even though some central banks later attempted tightening measures, the broader financial system remained flooded with liquidity. And this matters because when currency supply expands faster than the production of real goods and resources, prices eventually adjust. Sometimes that adjustment appears first in housing, sometimes in equities, sometimes in food or energy. And historically, precious metals often become one of the final warning signals. Why? because gold and silver tend to react not only to inflation itself, but also to declining confidence in monetary stability. When investors begin questioning whether currencies are retaining long-term purchasing power, capital often starts migrating towards scarce tangible assets. That process can unfold slowly at first, then suddenly all at once. Over the last year, many investors believed inflation was finally under control. Central banks raised interest rates aggressively. Consumer demand slowed. Economic growth weakened in several regions. But recent data suggests inflationary pressure may not have disappeared as cleanly as policymakers hoped. Energy costs remain elevated. Shipping disruptions continue affecting trade routes. Geopolitical instability is increasing. Food prices remain vulnerable to climate and supply disruptions. At the same time, governments continue carrying enormous debt burdens. This creates a difficult situation for central banks. If they keep interest rates high for too long, economic growth weakens further and debt servicing costs rise sharply. But if they cut rates too early, inflation could accelerate again. This is the trap many macro analysts now believe the global economy has entered. And in environments where confidence in monetary policy weakens, commodities historically perform very differently than traditional financial assets. No discussion about commodities today is complete without mentioning the 1970s. That decade became one of the most powerful inflationary periods in modern financial history. Oil prices surged dramatically. Gold experienced an extraordinary bull market. Silver exploded higher. Consumer prices climbed persistently. Several conditions drove that cycle: loose monetary policy, currency instability, energy shocks, rising geopolitical tensions, weak confidence in traditional financial systems. Now, analysts are debating whether portions of that environment may be reappearing. Today's economy is obviously very different from the world of 1971. Technology dominates markets. Globalization changed trade systems. Digital finance transformed capital flows. But some similarities are difficult to ignore. High debt levels, persistent inflation concerns, currency expansion, supply chain instability, growing geopolitical fragmentation, and perhaps most importantly, investor psychology may be shifting. For years, many believed central banks could permanently stabilize markets. Now, confidence in that assumption is beginning to crack. One of the most overlooked parts of the current rally may actually be happening inside mining shares. Historically, mining companies tend to behave differently than physical metals themselves. Gold and silver can rise gradually, but mining stocks often move with much greater volatility because investors begin pricing in future profit expansion. If metals prices rise while mining costs remain relatively stable, mining company margins can increase dramatically. That is why experienced commodity investors frequently monitor junior miners closely. These smaller, more speculative mining firms often attract capital early during major commodity cycles. And recently, several mining indexes have started showing renewed strength after long periods of underperformance. For institutional investors, this matters, because large money managers rarely chase speculative sectors unless they believe broader macro conditions are changing. Mining stocks may therefore be acting as an early signal that sophisticated capital expects commodity prices to remain elevated longer than many mainstream forecasts currently assume. Silver may be getting headlines, but the broader commodity landscape is also shifting. Oil markets remain sensitive to geopolitical disruptions. Copper demand continues growing due to electrification and AI infrastructure expansion. Agricultural commodities face climate-related uncertainty. Natural resource nationalism is increasing worldwide. Meanwhile, several governments are becoming more protective of strategic materials and supply chains. This trend is critical, because modern economies still depend heavily on physical resources, regardless of how digital the financial world becomes. Artificial intelligence requires energy. Electric vehicles require metals. Data centers require infrastructure. Defense industries require raw materials. In other words, the global economy cannot function without commodities. And after years of underinvestment in mining and energy production, supply constraints are becoming increasingly visible. This is one reason why some macro strategists believe the next decade could look very different from the previous one. The last cycle rewarded software and financial assets disproportionately. The next cycle may reward scarcity. Retail investors often assume market moves begin after headlines appear. But institutional positioning usually starts much earlier. Large funds monitor liquidity conditions, inflation trends, bond markets, currency strength, and capital flows continuously. And lately, several signals suggest institutions may already be adjusting exposure toward hard assets. Even sovereign governments are increasingly focused on resource security. This matters because major market transitions rarely happen overnight. They develop gradually beneath the surface before eventually becoming obvious to the public. By the time mainstream consensus fully accepts a new trend, much of the easy upside may already be gone. That is precisely why analysts are paying close attention right now. Not because the move is guaranteed, but because the early conditions resemble previous periods that later produced enormous commodity rallies. Of course, no market moves in a straight line. And despite the bullish excitement surrounding precious metals and commodities, there are still serious risks that could interrupt or reverse the trend. A sharp global recession could reduce industrial demand. Central banks could tighten liquidity more aggressively. A stronger US dollar could pressure commodity prices temporarily. Geopolitical tensions could unexpectedly ease. Additionally, speculative rallies often experience violent pullbacks. Silver especially is known for dramatic volatility. That means investors chasing momentum without understanding risk management could face significant losses during corrections. This is why experienced traders focus not only on price moves, but also on broader confirmation signals. They monitor inflation expectations, bond yields, commodity indexes, mining stock performance, central bank policy, currency markets, because sustainable commodity bull markets usually require multiple macro factors aligning simultaneously. So where does this story go from here? That may depend on whether inflation remains structurally elevated over the next 12 to 24 months. If inflation cools meaningfully and economic growth stabilizes, commodity momentum could slow. But if liquidity expansion continues while resource constraints intensify, the current rally could become much larger than most investors currently expect. This is the scenario many macro strategists are now debating intensely. Not whether commodities can rally temporarily, but whether the global economy is entering a longer-term transition away from an era dominated almost entirely by financial assets. And if that transition accelerates, sectors ignored for years could suddenly become central to global investing again. Precious metals, energy, industrial materials, agriculture, infrastructure, assets tied to the real economy. The biggest story here may not actually be silver. Silver is simply the signal attracting attention first. The deeper story is that investors around the world are beginning to question whether the financial system can continue operating under the same assumptions that dominated the last decade. Can debt continue expanding indefinitely? Can currencies absorb endless liquidity creation? Can inflation remain controlled despite structural supply pressures? Markets are now attempting to answer those questions in real time. And whenever confidence begins shifting, capital moves fast. That is why experienced investors are watching this moment so closely. Because if the current commodity breakout evolves into a full-scale macro rotation, the implications could extend far beyond precious metals. It could reshape portfolios, sectors, currencies, and investment leadership for years to come. The next phase of this story may already be unfolding.